seen? What is the outlook on domestic pharma? Are there price hikes on the cards for some of the pharma companies? Aditya Khemka is fund manager InCred Health Fund, and he now joins in on the show to give us an all-round perspective. Thank you so much for taking time out, Aditya. To begin with, just sum up what have been some of your key observations for the pharmaceutical sector in particular. Do you believe that we will see high raw material prices continuing to play spoil sport?
So yeah, thanks for having me. So the raw material prices in the pharma sector have actually begun to cool off in the last 6 months, which has primarily been linked to oil prices, reduction in logistic cost, etc. However, because of fresh COVID outbreak in China, what we are hearing is raw material costs for COVID-related products still continue to go up or remain slightly inflated. But that's a select bunch of products which are used during COVID or treatment of COVID. Barring those products, for a majority of the other products, what we understand from the industry is that raw material costs are coming off, and that should help the margins of primarily those players who sell products in India, because they've taken price increases in FY23, but their raw material costs have actually gone up more than the price increase. Therefore, their margins were slightly muted in FY23, but FY24 should help see reduction in raw material cost and therefore improvement in overall margins.
Okay, fair enough. That's the outlook coming in on the overall raw material price. So you believe that some of those concerns will now be alleviated. Domestic pharma business, you believe that is going to be the key area for growth? What's driving that optimism?
So the domestic pharma has been, over the past decade, one of the best performing segments for Indian pharma companies. Just to give you a perspective, the domestic pharmaceutical industry has grown to 12% CAGR over the past 10 years, whereas the export market has been significantly subdued, especially due to the pricing pressure that we have seen over the last 5 to 7 years. However, in FY24, what we believe is that the government will again allow pharma companies to take price increases anywhere in the range of 12 to 13% on the NLEM drugs, and the non-NLEM drugs again about up to 10%, which will help the price increase, which will help the price realization in terms of growth. And then the volume growth in the industry has been around 5 to 6%, including new product introductions. So overall, the market can grow, in mid to high teens. And therefore, the companies which will do better should grow better than the market. So you will see some of these smaller companies which are more focused on the Indian pharma industry growing top line in more than mid-teen in the India market. And that definitely will result in higher operating leverage, and the bottom line will grow faster. So we believe some of these stocks are extremely cheap in the current operating environment just because they are small and mid caps. They are not being recognized by shareholders or as investors as credible companies, but we do recognize them as companies which have brands, high amount of cash flow, very efficient balance sheets, and very efficient working capital. So we really like some of these companies that are smaller in size, focused on the India business, and we feel that the growth in the India business will make them do extremely well as stock prices in FY24.
Why is the export data which came yesterday for DVs and for Gland Pharma is not encouraging? We are talking about turnaround, pricing power coming back, CRAM business doing well, but rather than growth, there is contraction.
Right. So, see, you have to understand that DVs and Gland Pharma, the two companies that you mentioned, a lion chunk of their business. So they are both different companies, they are different businesses. But let's take Gland, for example. So I think more than 90% of Gland's revenue, in my understanding, is purely generic. It's not branded generic. And because it's unbranded generic, the pricing power in unbranded generic just doesn't appear, because the supply is more than the demand. So even if there is raw material inflation, which there is for unbranded generic as well, instead of increasing prices, they're actually still decreasing prices because the competition keeps going up. And if that happens, then you have a double whammy, on the company, where the selling price is coming down and the purchase price of raw material is going up. So you get squeezed on margins, and obviously your revenues also get squeezed because your price realization is coming off. Same goes for DVs, but DVs, only a portion of their business is unbranded generic. But the trouble that they are witnessing is in that portion of their unbranded generic. Also, DVs last year had significant sales of COVID-related products, which are not recurring this year. So DVs is a slightly different matter, I would say. But Gland, I think, is a prime example of, where the unbranded generic business is just going down the road. It's in a structural decline, And we don't see a near-term recovery to that business, which is why we are not very optimistic about companies like Gland or many other large cap pharma companies, which have significant exposure to US and Western European businesses.
Sector has a headwind, whether it is pricing power, commodity prices, large companies not doing well. Historically, we've seen, barring one or two small and mid cap stocks, the sector does not do well. P expansion will not happen. Pricing issues will always be there. So why should one go against the grain? When you have more headwinds than tailwinds, why buy pharma at all?
No, that's a fantastic question, and I would like to elaborate here. If you divide the BSE healthcare index, so if you take the last 10 years, right? So last 10 years, I think, had you invested 100 rupees in Nifty, today you would have around about 300 rupees. 10 years ago, had you invested, let's say, 100 rupees in BSE healthcare, today you would have around about 310 rupees. So you would have outperformed Nifty by 10 rupees by just investing in the healthcare index. But this is the fun part. If you break up the healthcare index into two halves, the first half of market cap, which is largely those companies which are invested in US market, and the second half is everything else. So companies which are invested in the India business, hospitals, diagnostics, API, chemical companies, those are the other half. So had you invested only in the US centric companies over the last decade, if you had invested 100 rupees, today you would have about 200 rupees. So, and if had you invested 100 rupees in the second half, which is API, diagnostic, hospital, and India centric pharma companies, then you would have 600 rupees. So you have to understand, when you say the sector hasn't worked, you are actually focusing on the index, which is 100 to 310. But if you focus on the second half of the index, that is from 100 to 600. And that has outperformed Nifty by 300% over the last 10 years. So the sector has actually done extremely well. It is the largest pocket of the sector, which is the US-centric pharma companies. They haven't done well. And I'm saying that they will not do well because that business is in a structural issue situation. And therefore, you need to avoid those companies. When you look at the sector, you look at companies like Sun Pharma and Cipla, and you come at a conclusion as to how the sector is doing. I don't think that's fair. There are some 300 listed pharma companies. Why do you look at two companies and arrive at a conclusion as to how the sector is doing?
Sure. Okay, Aditya, great to have you on the show. We'll let you go on that note. Thanks as always for joining in.
Thanks, guys.
Okay, let's also